Thank you very much for attending today's ABFER session. I'm Roger Loh from Singapore Management University. So we have 4 very interesting papers, and we're going to start off with the paper Taking Sides on Return Predictability by Jeff Pontiff, David McLean, and Christopher Reilly. Okay, it's going to have 20 minutes to present, followed by 15 minutes discussion and 10 minutes Q&A. So this Zoom session, I've asked for it to be open, so anyone can type questions anytime into the chat. Of course, he'll answer them at the end, but anytime, please type into it. And at the end of the Q&A, if we can, we can have people ask more questions or ask over the microphone as well. Okay, Chris, 20 minutes, go ahead.
Okay, thank you, Roger. So first, let me thank Roger and the organizers for including our paper. It's a real honor to be such part of such a great program. This work is co-authored with David McLean at Georgetown University, Jeff Pontiff, who's also in the audience, so he might field some questions, and myself. And we're really excited to hear Tarun's comments. We're in the middle of editing the paper, and so I'm sure his insights are going to be very valuable. Okay. So what we do in this paper is we study the relationship between trades made by retail investors, variables that predict the cross-section of stock returns, which the literature widely refers to as anomalies, and then both of those things relationship to future stock returns. Fundamentally, we ask whether retail investors trades with or against anomaly strategies, whether their trades are associated with future stock returns, and whether that association between retail investors' trades and future stock returns can be explained by their anomaly exposures. And in order to do so, in order to contextualize retail investors, we're also going to investigate 8 other market participants and do an apples-to-apples comparison. Some of these market participants have been previously studied, but we're going to look at a wider set of horizons and use a wider set of anomalies. And then for some market participants, we also think we have some contributions and new findings to the literature, especially when it comes to firms and their issuance decisions. Okay. So if you can observe some stock characteristics that underpin anomaly strategies at time t, so if you imagine those characteristics are observable at time t and you perform a sort on them, we're going to look at the different market participants' tradings at different horizons relative to that period of time. So first, we're going to look at their trading prior to the stock anomaly strategies forming portfolios, both over a 3-year horizon and a 1-year horizon. Then for some market participants, we're going to look at their holdings at the time of the anomaly sorts. And then lastly, to answer whether different market participants tend to be conditioning on this anomaly information, we're going to look at their trading for the following quarter. So big picture, what we find, unsurprisingly, we find retail investors do the worst. They tend to buy stocks that are in anomaly shorts, and they sell stocks that are anomaly longs. They do this both before the anomaly characteristics are observable, and then even after the anomaly characteristics are observable, they still tend to trade in the direction not suggested by anomaly strategies. Their trades are also negatively associated with future stock returns, and this association can be partially explained by the anomaly exposure, but even after accounting for their anomaly exposure, they still have a negative relationship with future stock returns. So it looks like retail traders get anomalies wrong, and they also get some other things wrong as well. Conversely, firms do the best. Firms issue more shares when their shares are going to be in anomaly short portfolios. And additionally, confirming prior findings of the literature, firms' issuance decisions are associated positively with future stock returns. Short sellers also do well. They build short positions in stocks that are going to be in more anomaly short portfolios and cover positions in stocks that are going to be in anomaly long portfolios. And at the time of the portfolio sort, they have larger short positions in anomaly shorts. Institutions' long positions are less clear. They're more sensitive to the horizon of what we look at. If you look at their holdings, institutions as a whole tend to hold more anomaly shorts than anomaly longs, but their trades aren't always associated with anomaly exposures, and they aren't associated with future return predictability. One notable exception is hedge funds' long positions surprisingly tend to trade against anomalies, both before and after anomaly characteristics are observable. Before you think hedge funds get it too wrong, it's my opinion, and I think my co-author's opinion, that the short sellers in our sample are likely mostly hedge funds, or a large portion of them are hedge funds. So in some sense, you might better conceptualize it as the long positions of hedge funds are poorly positioned with regards to anomalies, but their short positions are well positioned with regards to anomalies. Okay, for the sake of time, I'm going to be very brief here. There's a big literature that we are borrowing from, but I'm going to try to highlight what we think our new contribution is. So it's been understood that over short horizons, retail orders are positively related with future stock returns, but over long horizons, say more than 3 months, their trades tend to be negatively correlated with future stock returns. And the studies that have actually looked at their explicit profitability have found similar results. We're going to confirm that finding in our sample, but we are the first paper to look at the anomaly exposure of these retail trades. And we find that both over short and long horizons, retail trades tend to be poorly positioned with regards to anomaly strategies. We're going to show that some of this long horizon negative association between their trades and future returns can be explained by the anomaly exposure, but a lot of it is still unexplained by the anomaly exposure. And then lastly, firms have been, their relationship to a few famous anomaly strategies have been studied. For example, the profitability and size anomalies. But we, to our knowledge, were the first paper to look at firms' issuance decisions in relationship to a wide set of anomaly strategies. And we find that firms issue more shares when their shares are in anomaly short portfolios. So if you conceptualize anomalies as a decent proxy for mispricing, this can be consistent with theoretical frameworks in which firms issue more shares when they think their shares are going to be overvalued. Okay, so let me talk about a little bit about how we construct our variables and our empirical strategy. So we use a sample of 130 stock return anomalies that are documented in published academic finance and accounting literature. This is an expansion of the anomalies that underpin a lot of Jeff and David's prior work. So we're going to sort stock based on observable characteristics. A lot of these characteristics are coming through some combination of CRISP, CompuStat, and IBIS data. And we're going to define the long and short side of each anomaly strategy as the extreme quintiles produced by those sorts. If the characteristic is a binary variable, we're going to just simply define the long portfolio as the binary state that has higher returns and the short portfolio as the binary state that has smaller returns. And with those anomaly portfolio memberships, we're going to calculate net, which is just going to be the simple difference between the number of long portfolios a stock belongs to and the number of short anomaly portfolios that a stock belongs to in a given month. Jeff and David have relied on this measure before in some prior published work. And you can kind of think of it as an equally weighted measure between the 130 different anomaly strategies. A future draft of the paper, we're also investigating where we try to do kind of an optimally weighted net measure where we place bigger weights on anomaly strategies that have bigger return predictability. So if you're interested in that, there should be a draft hopefully coming shortly, so keep an eye out for that. Okay, to identify retail trades, we're going to rely on a methodology introduced by Bomer, Jones, and Zhang to identify retail trades in TAC data. So they have this paper where they make the very smart insight in which that retail orders originating from online retail brokerages are likely to be internalized, either transacted against the broker themselves, or the broker will sell their order flow to an electronic market maker who will transact against the retail trader, right? And for regulatory reasons, when this happens, it's very common practice for the trades made by retail investors to receive a couple hundredths of a penny price improvement over the best bid or the best ask. Conversely, institutional trades, it's very hard to transact at fractional pennies, particularly fractional pennies that are far away from a half penny due to, say, a pegged order. So if you look at the trade reporting facility within TAC, the correct trade reporting facility, and you see a trade that transacts at a fractional penny, you can reasonably infer that it must have been a marketable order that originated from an online retail brokerage. Their paper also validates this metric with some non-public data and find that it's a very good proxy for retail trades. So once we've identified trades in the TAC tape that originate from retail brokerages, we're going to calculate the daily percentage of equity purchased by retail traders. So this is going to be the retail buys minus the retail sells divided by shares outstanding. So we introduce this new aggregation technique to the literature of the Bomer-Jones methodology. And we think it's a good proxy for retail traders' actual portfolio weights because it's going to represent what percentage of the shares outstanding retail traders net purchased throughout that period of time. And it's also going to facilitate apples-to-apples comparisons with other traders when we scale by shares outstanding. We're going to aggregate this over various horizons ranging from a quarter to 1 year to 3 years. And then lastly, as I said, the Bomer-Jones and Zhang methodology, the identification is based on modern market microstructure, the fact that retail trades are internalized. And when we go to the data, we see our ability to identify retail trades begins increasing rapidly near the end of 2006. So we're going to restrict our sample to that time period. Okay. For the other market participants, we're going to use various different data sources. For institutions, we're going to infer trades based on changes in 13F holdings. And for mutual funds, we're going to use S12 holdings. There's details in the paper, and I don't have time to go into exactly how we classify into the different institution types. But I want to highlight that for hedge funds and wealth managers, we're going to deviate a little bit from the prior literature and identify using text criteria on their names. We think this is a better bias-free measure. We're going to particularly try to leverage the fact that wealth managers and hedge funds are often incorporated in a different structure than other institution types, like, say, LLPs. For short sellers, we're going to take changes in percentages of shares shorted. And for firms, we're going to look at net issuances. And we're going to assign all these variables so that positive values are represented like the equivalent to a buy, and negative values represent equivalent to a sell. So for firms, a positive value means the firm is a net repurchaser, and a negative value means the firm is a net issuer. And then lastly, a common question is, does all this sum up to one? And the answer is no, and one of the most important traders that we don't observe are foreign institutions. So as I mentioned in our approach, we're going to conduct these 130 different anomaly sorts at time t. We're going to calculate net as the number of long portfolios a stock belongs to minus the number of short portfolios a stock belongs to. And then we're going to perform another quintile sort on that net variable itself. So in the tables that you see, the low quintile are going to represent stocks that tend to belong to lots of anomaly short portfolios and few anomaly long portfolios, whereas the high quintile are going to be stocks that are going to belong to lots of anomaly long portfolios and few anomaly short portfolios. And we're going to look at trading and ownership at the horizons I previously discussed. We're going to report T-stats on the significance of high minus low. And we're going to use Newey West standard errors with an appropriate number of lags to account for the overlap in our measurements. Okay, so this is the trading by traders before the anomaly sorts occur. And so if you read across the first row, the retail trading, what you can read is that for stocks that are in lots of anomaly, that are going to in the future be in lots of anomaly short portfolios, retail traders on average buy 10% of shares outstanding. Conversely, for stocks that are in lots of anomaly long portfolios, retail traders sell on average 0.02% of the shares outstanding, and this is statistically significant. So in summary, retail traders, before the anomalies are observable, retail traders tend to trade against the future anomaly, trade counter to the future anomaly recommendations. Hedge funds show a similar dynamic. They purchase more stocks that are in the future going to be anomaly shorts and sell more stocks that in the future are going to be in more anomaly long portfolios. On the other end, short sellers and firms look better positioned. So short sellers open larger short positions in stocks that are going to be in anomaly shorts, and they actually cover a bit in stocks that are in the future going to be in anomaly longs. Firms are net issuers in our sample, but they issue far more if their shares are going to in the future be in more anomaly short portfolios. Insurance companies also look like they get it right. They trade in the right direction, but as you'll see, this is sensitive to the horizon. So we don't necessarily want to overinterpret this finding. So if we also look at three measures, you'll see another consistent story. So retail traders trade counter to the future recommendations of anomaly strategies. And again, hedge funds trade counter to the recommendations of future anomaly strategies. But short sellers and firms look to be getting it right in that they are trading in a way that they're building positions in the stocks that you want to be holding in the future based on anomaly recommendations. Okay, so next we look to the holdings, contemporaneous holdings at the time of the anomaly sorts. And unfortunately, we cannot construct this measure for retail investors because we don't only observe trades and not holdings of retail investors. And for firms, this measure doesn't have much economic meaning, so we're also going to leave them out. So we're going to limit it to institutions and short sellers.
5 minutes, Chris.
Yep. If you look at the holdings, all of our different institution types hold more of stocks that are in more anomaly short portfolios than the stocks that are in lots of anomaly long portfolios. So their holdings are all poorly positioned with respect to anomaly strategies. Consistent with the trading results I just showed you, short sellers are well positioned with respect to anomaly strategies. They were building short positions, and then at the time of the anomaly sort, you see that they have larger short positions in stocks that are in lots of anomaly short portfolios and smaller short positions in stocks that have anomaly long portfolios. Then lastly, we're going to look at trading after the anomaly characteristics or the anomaly portfolios are observable. And this is particularly important because it allows you as the audience to infer to what extent these different types of market participants are conditioning on this information. We find that retail traders continue to get it wrong. They continue to sell anomaly longs and they continue to buy anomaly shorts. Hedge funds actually have the same result. They continue to sell anomaly longs and buy anomaly shorts. Short sellers and firms aren't statistically significant, but it looks like firms actually continue to maybe get it right. They continue to issue slightly more, but that should be taken with a big caveat since there's not statistically significance. And if anything, short sellers might exit the position too early. You see them actually covering their short positions that they've built in anomaly shorts and actually building short positions in the anomaly longs. Okay, now we look at the relationship between those different trader types and future returns. And to do so, we're going to estimate Fama-Macbeth regressions of returns on lagged trades. So the very first row, you can see that this net measure is positively associated with future returns. So to the extent our sample doesn't overlap with some of the samples of the 130 different anomaly strategies, it shows that there's at least some level of out-of-sample return predictability to these anomaly strategies. Retail trades, as you can see in the second row, are negatively, long horizon aggregated retail trades are negatively associated with future returns. But this weekly order imbalance measure at the bottom is actually Boehmer, Jones, and Zhang's short horizon retail measure. And you can see that it's positively associated with future returns. So this confirms this kind of horizon dependency for retail trades in their relationship to future stock returns. Then lastly, short sellers and firms are positively associated with future returns. This is the reason why these are the basis of anomalies themselves that we've excluded from our sample, because they've been shown to be associated with other returns. Institutions are not related with future returns. So lastly, we're going to try to explain to what extent can this return predictability that I just showed you be explained by the anomaly exposure I showed you at the first half of the presentation. And so before the results I just showed you, we kind of had a crude control for anomaly exposure by just including the net variable. And now we want to more completely control for that. So we're going to orthogonalize returns to the 130 different anomaly strategies. So we're going to regress returns on the 130 long-short anomaly indicators, and we're going to take the residual and see how trading is related to that residual. So here, if you look at the first column, you'll see that long horizon retail trading is still negatively correlated with this return residual. So you can reject a null hypothesis. We can reject a null hypothesis that the poor return, the return predictability of retail trades is fully explained by their anomaly exposure. The weekly order imbalance, this short horizon retail measure, is positively associated. This is not surprising. Even over short horizons, retail trades are negatively exposed to have a negative correlation with anomaly exposure. So after you control for anomaly exposure, if anything, those short horizon trades look even better. And then lastly, short sellers and firm tradings are no longer significant. So what this means is that you couldn't reject a null hypothesis that firms or short selling's returns predictability is fully explained by other anomaly strategies. So in conclusion, I've shown you that firms and short sellers appear to be smart money. Their trades generally trade in a manner that's consistent with anomaly recommendations, and their trades predict returns in the right direction. If anything, short sellers might seem to unwind their positions a little too early or a little more quickly. Conversely, retail investors do the worst. They trade against anomalies, both before and after anomalies are observable. Their trades predict returns in the wrong direction, and that return predictability persists even after you account for anomaly exposure. Institutions, it's more muddled. Their holdings are poorly positioned with respect to exposures, but their trades are not always associated, and their trades aren't necessarily associated with future returns. But of particular notice, hedge funds, at least their long positions, their trades actually tend to trade counter to anomaly strategies. So thank you very much, and we'll look forward to the discussion.
Thanks, Chris. The discussant will be Tarun Chordia from Emory. Tarun, go ahead and share your slides. You have 15 minutes. Okay, great.
Yeah, okay. So yeah, thanks for this opportunity to discuss this paper. And I enjoyed reading it. And this paper just follows a natural stream of what these authors are doing. So let me look at the motivation of this literature, and I'll talk about this again. So what drives the profitability of anomalies, right? Is it data mining? Lanama and Roberts have this paper. Is it mispricing? And this is some award-winning paper from some authors. Are small stocks or frictions causing this? That's the Zhang paper. P-hacking, multiple hypothesis testing. So again, I'll come back to these questions because this is the framework in which we should think about this anomalies literature. So this paper asked, do investors trade in the right direction? And which investors trade in the right direction? And by right direction, meaning consistent with the anomalies. And how do investor trades impact the returns? Right? Again, taking into account that the anomaly returns are going to behave in a certain way. And do anomalies capture the impact of investor trading on returns? That's the last slide that Chris showed. And the presentation was very clear. Okay, so the idea is you compute this net, number of long minus short extreme quintile positions across 130 anomalies. So the number of anomalies has been growing as the authors have been working in this literature. And we have different market participants, firms, retail investors, mutual funds, banks, insurance companies, wealth managers, hedge funds, other institutions, short sellers. So the foreign institutions are not here, but this is a lot of work to get this data, right? They had to go to TAC for retail. They had to go to the 13F, S12, right? So a lot of work to get this data, right? So the retail trading comes from this Bomer, Jones, and Zhang. And after Reg and MS, you need to offer price improvement to avoid sending to the exchange with a superior price, right? So you internalize, you offer some kind of a superior price, and there's pay for order flow or internalization going on, right? Okay. The institutional traders, you're looking at change in quarterly institutional holdings, 13F findings, identify mutual fund data using S12, identify banks and insurance companies. Bashi has a paper in 1998. They follow the methodology. And they do textual analysis to identify wealth management and hedge funds. And remaining are other institutions. So a lot of work in putting this data together, right? It must have taken a lot of time. And there are 130 anomalies with, on this side, you're putting together the anomaly data, you're putting together the trading data. So a lot of work. And I commend the authors for this. And again, we have short selling, end of the month short interest from CompuStat. But who are the short sellers? Hedge funds. So this is what Chris was talking about, that maybe they are hedge funds. And this is what I was thinking when I was reading the paper. These have to be hedge funds. So again, I'll come back to this. Are short sales reported on 13F? I don't think so. So if they're not reported on the 13F filings, we have two different measures of the hedge funds, right? And what about the other people who might be short selling? So that's something I would like to get some information on. So again, share issuance for firms is a negative positions, share purchase is a positive position. And in this regard, I thought that share issuance is one of the anomalies. So it's not surprising that you're picking up, but it's 1 in 130. What would happen if you remove the share issuance from the anomalies and see whether that's, it may be slightly correlated with the anomalies. I don't know. Caveats: you will not capture all retail trades, right? Because some retail trades do not trade at sub-penny pricing, right? Maybe there's no price improvement, maybe there's no payment for order flow there. So you will not capture this, and you may misclassify some trades as retail, right? Again, we'll look into that. And not all institutions report, right? Institutions only with less than 100 million in assets and non-profits do not report, right? So all these institutions do not report. So you might be missing some institutional some institutions in this category. Okay, but the broad stuff, I think you will capture. The other thing is, when you look at this data, when you look at all of these, because you're getting the data from different sources, right? The institutional traders, the retail traders, from short selling, and when you add this up, then it's not going to add up to one. Forget the foreign institution, it's still not going to add up to one. There'll be a lot of double counting going on, right? Because short sellers are also hedge funds, and retail traders, you may not be captured. So I don't think it's going to add up to one. Again, we'll come back to this. So results based on past 1 year of data, the retail investors trade in the wrong direction, hedge funds trade in the wrong directions, firms, insurance companies, short sellers trade in the right direction. But for firms, just what you can do very easily, just throw out any anomaly related to stock issuances, and then let's take a look, or repurchases also. Just throw out everything related to those anomalies, and let's look at the results again. But I'm not surprised that the firms get it right, because firms have information. They know what's going to happen, right? So I'm not surprised they get it right, but let's make this result a little stronger. Based on 3-month post-formation, retail investors, hedge funds continue to trade in the wrong direction. Firms, insurance companies trade correctly. Short sellers cover positions, right? It seems they're doing the right thing. They have a really right, they're moving in the right direction prior to the portfolio formation, and they're covering the position. Okay, makes sense. Now this is, I was looking at this data. This is holdings, and if you look at all of them seem to get it wrong, in the sense the net, this is across the net, except for short sellers, right? All are holding, the holdings are wrong. But then what about derivative positions, right? Could any of these be holding derivative positions somewhere in their structure, right? They might be holding CDSs for all we know, right? And a lot of the anomalies may be moving with respect to some kind of a credit situation, right? Again, we don't know. What about indexers? They are forced to buy and sell as investors trade in and out as the index changes. Also, you may have mutual funds that are actively traded mutual funds, right? I don't know if you remove the index funds here, but suppose you didn't remove the index funds. A lot of the active funds are closet indexers. They may just tweak things at the margin. So they're indexing. So again, we have to be careful about what's happening to indexers, what's happening to the derivative positions. What is the economic impact, right? I was hoping to see some dollar amounts and firm size by net. So if you have that table where you have the net and all the different, I want to see the statistics by firms, right? What are these firms like? Are they really illiquid? Are they liquid? What's going on, right? Can you really short sell? Can you really trade? right? So maybe if you're holding a long position when you should be actually going short, the reason is maybe you just can't go short. Maybe it's just not available, and maybe the dollar amounts are really low. So, for instance, a hedge fund holds 5 billion of the high net stocks and holds 100 million of the low net stocks. Right? So, in terms of the holding right before the portfolio formation, in dollar terms, do they really lose money? Right? So I'd like to see the flow of money from the perspective of what's happening to the profits of what these guys are doing. Right? Purchase prices are hard to come by, but you had the ownership at a certain point in time, right? When they change. So maybe you don't have the initial one, but you can follow some prices and see what prices they bought at, what price did they. I mean, you're getting the return to be negative because you're following the returns. But if you follow the purchase prices, are they actually losing money? Right? So dollar amounts, that would be really interesting, I thought. And I think you can do it. It's not that you can't. Retail classification is based on sub-penny pricing. It may cause biases, right? For example, during this time of GameStop, it might be Morgan gets this large sell to be worked order. And when you get this large sell to be worked order from short sellers, Morgan may internalize and purchase orders and follow that the retail traders get sub-penny price improvement. But the order has been placed by Morgan. The active trader the Morgan gets some client, that's the active trader. They're slowly working the order. It might not look that they are the ones who are actually putting in marketable limit orders, but they are the ones who are picking up the orders as and when they become available, right? So there could be some misclassification, and I don't know how to address this, but at least you should caveat this.
5 minutes.
And also, sorry?
5 minutes.
5 minutes. Okay, no, I'll be done. Now, this is the table where Chris was showing us. So retail traders, they lose money, they make money here, right? This is the weekly order imbalances. So he emphasized this. Long-term, retail traders lose money. Short-term, they make money. But what are the dollar amounts, right? Are they consistently losing money? Then how do they survive in the market? I'd like to see some story about this. Are they losing $1 here and making $20 here? In which case it's fine. Are they losing $200 here and making $1 here? Right? Some kind of dollar story would help me. And hedge funds seem to make money in the shorts. I think Chris talked about it. But again, what are the dollar amounts? Is it that these numbers are really, really large compared to what you get from the 13F? Firms time the market, but again, take a look at share issuances and anything to do with repurchases. In 1 year trading, short sellers, so in the other table, firms weekly OIB impacts returns positively and bank trading impacts it negatively. So those were the results. Why not use risk-adjusted returns, right? Could it be that once you control for risk, people are trading in the right direction, right? I just wanted to see one table. You could easily throw it in. It's not hard. I suspect it's not going to change things, but still, just for completeness, I think you should be able to do it. Suggestions, right? Control for standard factors. I talked about this. Economic impact in terms of dollars. To me, I think that's worth doing. What impact do anomalies have on total returns? Right? The actual dollar returns may be small, as anomalies may not really exist. Right? Remember, I talked about the papers initially, and the authors of this paper have basically shown that after in recent years, the anomaly no longer exist. Maybe there's mispricing and hedge funds have eliminated the anomalies. Maybe the like Lanaima and Roberts are saying it was data mining, it didn't exist in the first place. So there are lots of things, and of course what Cam would say, it's all p hacking. So nothing really exists. So if the returns are not there, why would the hedge funds, why would the mutual funds, why would institutions trade in this direction? And maybe the retail traders are not losing that much money. They're making a lot more on the short-term order imbalance. Now, suppose the retail, I know you didn't do this, but suppose the retail holdings are 1 minus the 13F, or look at the Odin data set, right? Then what is the total return to investors and what is the impact of the anomalies? So there's no way to figure out what is the total return. Forget dollar return, just the total return to retail investors. We can only look at the part that's attributable, whether they're trading in the right direction or not. So maybe in the overall scheme of things, the anomalies are not that important, but the retail investors may be making money elsewhere and they're not paying that much attention to the anomalies. Maybe, I don't know. The impact of anomalies on holding-based returns of institutions. So again, holding-based return, which anomalies are important? What's driving this? So is it coming from long or short positions, right? Which anomalies matter, right? You can group anomalies, right? You have done this before. Just group them. Tell us at the market, what is driving these anomalies? And again, from Stambo Yuan, I think it's the short positions. But again, it'd be nice to see, right? You should be able to corroborate it. Robustness. So definition of net, I think Christopher was saying, yeah, they are looking at this. But I think you can get stronger results if you might just do some robustness. For example, Stambo Yuan use rank percentiles to identify overpricing versus underpricing, right? That's one way. I think you're thinking about this already. The reason I was a little concerned about net is because you have 130 anomalies, and given the stock, there might be 10 strong signals with a percentile rank of 19 and 0 long, so you get a net of 10 or maybe minus 10 here, and versus another stock with 0 long signals, 5 short signals with percentile rank of 1 and 100 signals with a percentile rank of 21. So the cutoff is 20, and these make it and these 100 signals do not, right? So maybe some robustness, that's all. And I think the results should go through, but should be easy to check, right? And I like this Stambo Yuan, just rank the percentiles, take an average and see where they fall, right? This is relatively easy to do. But again, I think you're thinking of how to address this. Final thoughts, okay? This is an interesting and important progression to what the authors are doing, the research agenda. How investors trade, we know very little of this, right? One of the big puzzles in the literature is, why do we have so much trading volume? Are investors reacting to anomalies? The question is, do anomalies matter in trading decisions? I think that's an interesting question. What impact does anomaly-based trading have on overall returns? The question that I was talking about, do anomalies even matter? Do they even exist now? Right, out of the 130, how many are still in this sample period, 2006 onwards? How many? And remember, the full implementation of Reg NMS took place in 2008, right? 2006 they were beginning, but it really happened in 2008. So if you look at that, the retail prior to that, I'm not sure how much you're capturing, but still, I think you're getting most of the effect.
Okay, Tarun, you're out of time. So
I'm out of time. Okay.
Yeah.
Final suggestion. What about transaction costs? Is shorting even possible for some of the stocks? Maybe this is the reason for not enough shorting, right? You're getting too many long positions in stocks they should be going short in. And maybe these are really small stocks and they don't matter for dollar amounts anyway. Anyway, thanks.
Yeah, great discussion, Tarun. Chris, maybe I give you 1 minute to respond to Tarun, then you can address some of the questions in the chat.
Can I just say one thing before Chris starts? Chris, why don't you answer everything that you want, and if there's anything left over, I will chime in at the end. And how long do we have, Roger?
We can take like 7-8 minutes. Go ahead. Yeah.
Okay, thanks.
Okay, yeah, thank you so much for Tarun. It's the very helpful feedback. It's great to hear. So first on the removing the issuance-based anomalies. So I should have been more transparent. We are already doing that. So we're excluding anomalies that are based on net issuances or repurchases and anomalies based on short interest. So the ones that are kind of mechanically related. And so they're still robust to those results. So about the kind of the errors in the retail trades, you're totally right that it's not a perfect measurement of retail trades. And the most obvious trade that it's going to miss is retail limit orders that sit on that aren't marketable at the time of placing the limit order are going to sit on the book and then get transacted against. That's not going to enter our measure. To some extent, we kind of have to just trust Boehmer, Jones, and Zhang and hope that it's a good proxy for retail trading. And when they use it, when they have private data that actually explicitly identifies retail trades, they find that it's very highly correlated, and it's kind of the best we can do. I think you're totally right that hedge funds and these other institutions might have derivative positions that are smart. I think it's a good point. We should mention it. It's kind of consistent with our findings that it looks like their short positions are better informed than their long positions. It's kind of a similar flavor. So I think that's great. And the holdings, I agree on the indexer. Part of the reason why we want to look at trades is because the holding results can kind of be a product of investment mandates, right? Like if institutions have investment mandates that they have to hold stocks that tend to be in the short end of anomaly strategies more often, that's not necessarily them getting it wrong, I would call it, right? But trades are going to kind of implicitly control for their own investment mandate by looking at changes in holdings. And so that's why we kind of come to the conclusion that institutions are more neutral. We should definitely do more on the dollar value. To some extent, we're trying to look at these trades and these holdings as proxy for portfolio weights and kind of think of them proxies for underweight versus overweights. So it's not necessarily that they're losing money. It's more that they are underperforming a benchmark, which is like a composite return of all the equities in our sample. So that's how we like to kind of conceptualize it, but we should do more to show that economic impact. And then, yeah, as you said, we are focusing on rethinking of, doing a robustnesses on our measure of net. And then the last thing, I think you talked about the limits to arbitrage and shorting. I definitely think that's going on. And I didn't discuss it in the presentation for this lack of time, but you actually see that in our results, right? You see the biggest difference in retail trading, for example, is in the low quintile. They buy lots of the positions in the low quintile. The same for hedge funds. And the same thing is going on the short interest. You see the largest short interest on the short end. Why that's not fully resolving the anomalies, I think a likely story is some story about limits to arbitrage and the cost of shorting, for example. So that's also a great insight. So thank you for that. Jeff, did I miss anything? Do you have any thoughts?
Well, you did, I think, a very good job. Let me just note, Chris is currently a fourth-year PhD student at Boston College. He'll be on the market next year. So whoever hires him is going to be very lucky. Usually I have heart attacks when my co-authors present papers. I think, I can't believe they said that. But Chris, I don't have to worry. He always does a very good job. And Chris, I think you basically got most of the questions. I'll try and go through some of the questions from the chat. Hopefully I can save them. I think we have a lot to think about from some of your questions. Tarun, one thing that a couple things I want to mention about some of Tarun's comments. I don't think we're double counting too much. I think we are losing stuff, but we're not double counting. All of the short selling is in our short selling measure. So you wouldn't get short selling in a 13F. Now, you could get derivative positions in a 13F, and George Aragon has a paper where he shows these are informed trades. We're not getting derivative positions at all, so we're missing that. So when we think about how good hedge funds are, we have to take our long measure and then add the derivative measure where they do well, and then add the short selling stuff where they seem to do well. Are these anomalies related to return predictability really? Well, what I would say is, in sample, clearly they are, okay? And are we picking up some in sample? Yes. My paper with David, we can reject both nulls. We can reject the null that the anomaly goes away entirely, and we can reject the null that it stays identically the same. So there's something there. Yes, it is lower post-publication, but there's still return predictability. Certainly our measures are not perfect, but I think it is, when I look through our literature, I think we're doing the best job to date. I'm sure in 5 years, someone will have 15 traders and 200 anomalies. But until then, my hope is that this is a pretty good roadmap for people to think about. The Bomer-Jones and Zhang measure, there's going to be an errors in variables problem there. We have to think about, I think Tarun's comment's great about the magnitudes. I still have to think about it. Certainly for the retail traders, we're only getting half. It's hard for me to imagine that half of the traders are trading in one way and the others are doing anything that is uncorrelated or negatively correlated. I think probably one is a pretty good proxy for the other, and the Bomer et al. Paper has results that seems to tell us that is pretty good. For our paper, it tells me that we have an errors in variables problem. So when you look at the T statistics on retail traders, they're going to be too close to a zero. So I'll turn a bad thing into a good thing by saying just double all of our T statistics and I'll be closer to reality. Some of the chat questions, I have to think about these.
So Jeff, why don't you finish up, say something about the endogeneity, that's the trading costs, the anomalies. I guess both Johan and Utpal asked this question, and then we will move on to the next paper.
Sure. Does trading itself affect anomalies? If yes, there may be a chicken and egg problem. Yes. I mean, certainly trading affects anomalies. I think we can certainly say something about that before the anomaly sort. So our first results, where we see how people are trading before we know what the anomaly is, I think we're going to be able to speak about that quite well. Some of our other results, like other papers, we may have to wave our hands a little and be thankful that we're in asset pricing and not corporate. But thank you, Tarun, for the great comments. And hopefully I can copy and paste these chat questions. Clemens has a good one I have to think about.
Yeah. All right. Thank you very much.